Welcome to RenMac Off-Script, where we open to discuss markets, economics, policy, history, and life. It's the 12th of April, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account at RenMac LLC and our LinkedIn page. And if you'd like more insight, go to renmac.com for a trial and see how we think about the world in a more formal format than this one here. I went to the eclipse last week, guys. My son is at school in the Midwest, so it just happened to be in Indy. I will tell you, I kind of did it reluctantly, but I did it to see him, really. But I will tell you that the eclipse in totality is unbelievable. And I'm not, one of these guys, but it is it was worth it. I would just say, and it's not, you can't be like, oh, it was 99% or it was 95%. No, totality is completely different. And it really was spectacular. So, in 20 years, when the next one comes around, make sure that you, wheel your little chair out there into the grass with your blanket on and look up to the sky and see the eclipse, because it definitely is worth it.
Can I ask, was that before UConn eclipsed Purdue?
Oh, but a bum. Yeah, that was ugly. All right, you want to take the gloves off? Let's talk about gold. So you had a piece out talking about gold sanctions and the like, and we're going to get into this because it all ties into Neil's world of inflation and then our world and everything else. But within that, talk a little bit about how you're seeing gold and the current buyers, which, by the way, the data is correct. That's not like an assumption. When we look in the futures market, it is not the small traders that are driving precious metals. It's actually the commercial hedgers, and those tend to be central banks and large institutions. But talk a little bit about the politics behind gold as you're seeing it.
Sure, I appreciate that caveat because I am viewing this through the policy lens. I'm not, just forewarning, I'm not a gold or commodities trader, but just sort of someone who can read papers and follow the info. I mean, central bankers have been buying gold, which I believe is a relatively recent trend, sort of started from after the global financial crisis, but probably accelerated more recently. And there are a few things driving that. One, you have following Russia's invasion of Ukraine, you have Russia and other countries doing business with Russia looking to circumvent U.S. sanctions. And so I think that's where a big part of this started. And then sort of related to that, China moving in that direction too. Again, this whole de-dollarization effort. And I think China's been the largest purchaser now for at least a couple of years. And I believe I saw 17 months straight. So this old adage, don't fight the Fed. Well, I mean, that probably applies to other central banks. They probably have a lot more money than most. If they're going to keep buying it, might as well hitch a ride. Not really applying any, significant market analysis here, just a lot of common sense. But you also look at what happened recently, and that's the expansion of BRICS. And China and Russia, that coalition, are two of the big drivers there. And that, again, goes back to we have these varying economies with different views and perspectives towards the U.S. This common theme, this common goal of not being susceptible to U.S. sanctions is driving this. And gold may be one reason for that, in addition to all the other benefits that it provides in terms of being maybe a hedge against the dollar and a safety trade. And I just think moving forward, that theme of countries not wanting to get caught up in U.S. sanctions is something to watch. Now, I'm more skeptical that they're going to develop an alternative BRICS currency to the dollar, just because going back to those varying economies, I mean, China and its dominance there, you think people might be more inclined to sort of have the yuan become sort of the preferred currency there. But there are a lot of problems with that, not least of which is Xi Jinping, 70 years old. He doesn't really strike me as the poster child of health. And I think it's sort of underappreciated because there is no succession plan to what happens to him afterwards. I think that's really one of the reasons you're seeing a lot of foreign investment drying up there, candidly. Again, this is just common sense, but there's a reason it's not as common as it should be.
Yeah, well, certainly it's sanctions are a byproduct of dollars. Dollars are a byproduct of holding treasury reserves, and if you start swapping those out because you don't want Big Brother looking after you, or maybe even arbitrarily assigning sanctions that you think are unjust, then clearly that's something that can start to gain some momentum. it's funny that it's a little like taxation, right? They tax cigarettes because they want fewer cigarettes out there and fewer people smoking, and I totally understand that. But at some point, you develop a black market, right? I mean, that's just the way it works. When things are excessive, black markets develop, and it's a little bit what you can see here, not only with gold but with crypto and the like. So that makes it less of an inflation play or inflation scare. And that's important because obviously the inflation data out this week put a little bit of a shock into the market. I think there was some resurrection or redemption, I should say, from the PPI. But Neil, talk to us about the inflation data. What does it do to the Fed? What does it do to your thinking? And how dangerous is it?
Well, I think it delays more so than derails. That's how I'm thinking about it. So you basically had 3 months of, let's face it, bad inflation numbers. You'll need at least that many months to undo the damage. So, between now and the July FOMC meeting, you'll have 3 PCE reports for March, for April and May and June. And so, you kind of take your lumps. I mean, there's a lot of sort of idiosyncratic stuff in that number. I mean, as an example, motor vehicle insurance surged. That was a big reason for why the consensus missed on core CPI, right? I mean, core CPI was 0.4. Had it not been for motor vehicle insurance, it would have been 0.3. So right on the nose. You
I
mentioned.
mean, my kids are driving age. That's it. Your nanny. I've heard stories.
What's interesting also is just you mentioned the producer price index. I mean, that certainly took some of the edge off the CPI number, because it does sort of drive home this idea that there are differences between PCE and CPI. In business economics, you have sort of multiple ways of looking at the same concept, right? You have gross domestic product and gross domestic income. You have the household survey of employment and the establishment survey. And inflation's no different. You have consumer price index and the personal consumption expenditures deflator. And there are differences of scope, right? Like the CPI only measures out-of-pocket expense. So that's why motor vehicle insurance is surging. But when you file a claim and get money back, that also counts for something. So that's net insurance. And guess what? That's what the PCE captures, which is why motor vehicle insurance in PCE isn't rising as rapidly as it is in the CPI data. Medical care services inflation, same deal, right? Medical care services inflation was rising very rapidly in the last CPI number. It's not going to be rising that rapidly in PCE. So there are reasons for the wedge, but as I say, at the end of the day, you're talking about even accounting for that. Core PCE likely rises 0.3%. It's going to be a soft 0.3 in my opinion, but you're still talking about core PCE inflation rising over 3% at an annual rate over the first 3 months of the year. Now, that's momentum. That's faster than the pace over the last 6 months, over the last 12 months. And so I think that's going to push back the timing a little bit. But whenever you have these sort of situations unfold, you always have to go back to first principles. I mean, where is the inflation coming from, right? I mean, that's what I keep coming back to. Ultimately, the labor markets are still cooling, right? And so we saw that again with the median wage tracker that was released from the Atlanta Fed. So wage growth is cooling. So if you do have a spike in inflation, right, there's only going to be so much of that consumers can absorb. I mean, remember, household and consumer inflation expectations are basically flat so far this year, even though we've seen this pickup in inflation. What that basically tells me is that consumers are going to get increasingly more, apprehensive about absorbing higher prices. They're going to push back. And if that's happening, they're going to make trade-offs. And that should mean retailers think twice about raising prices in the first place. And if that's the case, it's, sort of how do you have that kind of sticky inflation that everyone's worried about? So I still think the odds favor slower inflation over the next several months. And I think when the year is done and dusted, we'll still be talking about an economy that's been growing and a Fed that has cut.
I mean, the risk, obviously, and I want you to assess this. The risk is that things are slowing, and these are idiosyncratic, as you point out, and they're one-offs, and they're staying tighter longer, and it actually does impact the real economy, and they get kind of behind the curve. Now, you're not seeing it in the labor market. We're not seeing in the equity markets. We're not seeing it in the equity prices. But we have seen the spike in yields, right? And those spikes in yields historically put downward pressure on cyclicals versus defensive names in the index. Again, we're not seeing that translate. But what are the risks, in your opinion, that these idiosyncrasies put the Fed on pause longer than they otherwise should be, and they get behind the curve, and then they have to really catch up? In other words, they basically push us into recession by not being
By
a
not
little bit more
adjusting?
aggressive.
Well, I mean, yeah, I mean, I think that that's more of a risk. I mean, obviously, the longer inflation continues to do what it's doing, the more apprehensive the Fed's going to be about cutting. And to the extent that corporate enthusiasm has been driven to some degree by expectations of lower rates, and if those lower rates don't happen, then that's going to weigh on the corporate sector, and they'll in turn pull back on hiring and investment, and that will slow the economy. So, I think the Fed is cognizant of that risk. I mean, they have been talking about how, the balance of risk between growth and inflation have come into better balance. So I think if you do get some kind of growth scare, I think it'll be pretty quick that the Fed would start cutting at that point. So, I mean, there is that. So you could say that, the Fed is much more willing to step in to put a floor under equity market sentiment than had been the case maybe a year ago. And that's what should happen, because given where their policy is, they believe themselves to be very tight, right? So they should be much more concerned about downside surprises to growth than upside surprises to inflation.
I mean, real rates are above 2%. Our yield impact model is in the top decile, and historically, it's the only decile that you start to have an impact, a statistically meaningful impact on equity returns. Now, as a cautionary note, this is not a disaster for equities. Basically, you're running about 2 to 2.5% on a quarterly basis for equity returns, and this goes to zero, right? So you go from being up marginally to being flat. But it is statistically meaningful. So the real question becomes aggregate demand and, what the impact is there. And for us, we're going to look at that through the cyclicality, through, say, discretionary versus staples and the like. Those are ways that we, go through and measure that. But I thought one chart was interesting that we posted earlier this week, which was, seasonality. There's this old saying, sell in May and go away. It just doesn't work. It's not, I know it sounds good, but it just doesn't work historically. So if anything, during the year, a normal year, what you'd want to do is you'd actually want to be a seller in July as the earnings season kicks in, sit on your hands until the first part of October, and then start to add to the equity markets in October for the fourth quarter. In a presidential year, we actually get weakness here in April that accelerates into May, and essentially the low point is in the right around the Memorial Day holiday, where you actually want to move in and be more aggressive on the long side. So very, very much different from what you tend to see in a normal year. The presidential year actually has weakness in late spring, and then a torrid summer in terms of the rallies, which you certainly want to be a part of if seasonality is a play for you. Steve, let's talk real quickly on the chaos of the Republican Party with the speaker. How much danger is there? These outliers, I mean, they're just hurting themselves, with kind of this infighting. What exactly is going on there, and is even worth talking about?
Well, we're recording this Friday morning at about 9 o'clock, and this time stamp's important because Speaker Johnson, I believe, is supposed to meet with Donald Trump today. And I think actions speak louder than words. And my guess is that what Trump is trying to signal is that Representative Marjorie Taylor Greene's effort to remove Johnson is not in their electoral interest. And I think, that's a powerful signal. And obviously Green is close to Trump. And so I'm sort of skeptical that she's going to follow through with this if he tells her sort of behind the scenes, don't do it, because it's going to put us all at risk. So we'll see. It's still not clear whether or not they're going to be able to do something on Ukraine next week and what that's going to look like. And I guess that's going to be part of the conversation today too. And that again will be the catalyst to potentially remove Johnson. So yeah, I think that's sort of where things stand.
Yeah, I mean, I don't even know where to go with it. Hey, the Taylor Swift channel. Taylor Swift is on SiriusXM for the next month, channel 13. It's going to be a long month in the car for me, I can tell you that. Let's get back to next week. Neil, what do you have on the data docket next week?
It's going to be a busy week in terms of data. We're going to get, I'll be keeping an eye on retail sales. And the reason I'm going to be paying attention to that, this is going to be a March data point. But we did see a big upturn in apparel prices in the March CPI data. And remember, retail sales are a nominal data point, right? So if you don't see a commensurate increase in like clothing store and accessory store sales in the retail sales number, it kind of goes to this idea that people are making trade-offs, right? I mean, if apparel prices are jumping, but the real spending is going down, I mean, how long can those price increases stick? You've seen some evidence of that already over the first 2 months of the year. We've been talking a bit about that. But again, that kind of reinforces this idea that there's a limit to how much inflation we can really see in that situation. That's not the kind of demand-driven inflation that the Fed really does worry about. We'll also be getting data on housing starts and industrial production. So it's going to be a pretty busy week, and we'll also be getting a decent amount of Fed speak as well. So.
Yeah, you say that it's interesting.
I will also be on a beach, by the way, because it's our spring break.
Yeah, mine too. I'm not going to be on a beach, but college visits. Anyway, it's interesting you say that because this week, just yesterday, a lot of our oversold conditions in broadline retail, which are in positive relative trends. Broadline retail is a huge group, right? Amazon, Kohl's, the auto retailers, etc. But we saw in specialty retail, auto retail, and home improvement retail, each one of them oversold in our oscillator, still an uptrend, which as we label that is a optimal entry. So we've seen some weakness, but it's all within trend, and usually those end up being buy points, not sell points. So we'll watch that along with your data very carefully. Steve, I know you hit on some of it. Anything else going on in DC next week to pay attention to?
Yeah, I mean, beyond the Ukraine standoff, I think there's some high profile hearings to keep an eye on. You're going to have Catherine Tai, the United States Trade Representative, come to the Hill, so may get some information there on the tariffs and respect to trade policies with China. I think you also should keep an eye on an energy hearing in the Senate, chaired by Joe Manchin, fossil fuel friendly senator who's retiring, going to square off with Energy Secretary Jennifer Granholm. I'd be surprised if we don't hear about gas prices and electric vehicles. And then there's also going to be a Senate hearing regarding a lot of the chaos going on at Boeing, and they don't usually hold hearings to bolster the company. So, maybe an opportunity there for that day, depending on what you're trading. And then all week, it's sort of the spring bank, I think was the worst term I heard when I was at the Treasury Department in terms of the IMF World Bank meetings. So you're probably getting a lot of information in terms of like global economic conditions. So it's a busy week in DC because lawmakers are leaving town again the following week.
Yeah. Well, we'll be watching any cracks in the underlying armor of the rise in 10-year yield. So we got through that 440 resistance. 470 is the next resistance level. 440 now serves as support, with 425 the next support level on the downside for the 10-year yield. But looking through those higher yields, how do they impact home builders? How are they impacting discretionary versus staples? How are they impacting banks versus utilities? These will all be important tells for us in terms of kind of the legitimacy of the trend that we're seeing now in the 10-year yield, and whether that's going to be sustainable or this is going to prove to be just an overbought condition that is still within some type of range. So we'll continue to watch that. S&P holding up well. The breadth is still there in our view. 5105 is the support level, which is the ascending 50-day moving average. Still looking for that momentum reversion or a continuation of that momentum reversion of high momentum names versus low momentum names. Really kind of a nice setup here for that, particularly given some of the questions regarding the Fed and pushing their cut date out into the future. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and LinkedIn. And if you want deeper insight, go to renmac.com or renmacaccess.com. Sign up for a trial. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.